SK Hynix just handed investors one of the strangest market puzzles of the year. Its American debut was a triumph. The new Nasdaq-listed ADRs jumped nearly 13% on their first day, after the company raised $26.5 billion in the largest U.S. share sale ever completed by a foreign company. Then, Monday happened. SK Hynix fell 15.4% in Seoul, its worst session in nearly 2 decades. The decline helped drag South Korea's main stock index down about 9% and triggered a temporary trading halt. American investors had rushed in. Korean investors were rushing out. Both groups owned a claim on the same company, backed by the same factories, the same HBM chips, and the same exposure to Nvidia's AI boom. One market was paying a premium. The other was acting as if something had broken. If leverage caused the crash, investors may have an opportunity. If the market has started pricing in peak memory profits, SK Hynix may be sending a warning across the entire AI chip trade. My name is Phoebe, and you're watching TradingKey. Let's find out what caused the split, whether American investors are overpaying for SKY, and whether the AI memory supercycle has begun to lose momentum. Great wasn't great enough. SK Hynix did not release a disastrous earnings report before the crash. It had not released its final quarterly results at all. The first spark came from Korea Investment Securities. The brokerage projected second quarter operating profit of about 60.4 trillion won. That estimate implies growth of 61% from the previous quarter and more than 500% from a year earlier. The operating margin could approach 75%, which would set a company record. Those numbers describe an earnings machine. Investors still wanted more. Market consensus sat near 65 trillion won, so the new forecast came in about 8% below the number traders had priced into the stock. For an ordinary company, 500% profit growth would dominate the conversation. SK Hynix had risen more than 7-fold in 12 months. Buyers expected a perfect score, and the brokerage handed them a 92. The difference came from the way SK Hynix sells high-bandwidth memory. HBM sits beside an AI processor and delivers data at enormous speed. Nvidia's most advanced accelerators depend on it, and SK Hynix controlled about 58% of the HBM market by revenue in the first quarter. Customers reserve much of that supply through negotiated contracts. SK Hynix locks in volume and pricing before delivery, giving the company stable orders and strong margins. Those contracts also limit short-term upside when spot memory prices jump. Korea Investment estimated that conventional DRAM prices rose about 30% during the quarter, while NAND prices climbed roughly 50%. Samsung and Micron have more exposure to those products, so they may capture more of the spot price surge. SK Hynix chose predictability. It cannot renegotiate every HBM contract because the price of ordinary memory went up last month. That trade-off matters. The company did not lose demand. Its blended selling prices may show less acceleration than investors expected because its best product comes with prices negotiated in advance. Korea Investment still maintained a positive rating and a 3.8 million won price target. The analysts revised an aggressive earnings model. They did not uncover disappearing Nvidia orders. A modest forecast adjustment can explain caution. It cannot explain a historic one-day collapse on its own. The American listing supplied the next piece. Same company, 2 prices. SK Hynix priced its American depository receipts at $149. They opened at $170 and closed near $168, gaining almost 13%. Each ADR represents 1/10 of a common share in Seoul. The company sold 177.9 million ADRs, equal to about 2.5% of its total equity. Demand exceeded the available offering more than 7 times. A limited supply of ADRs met a wall of American money looking for direct exposure to the leading HBM producer. By the end of the first session, the ADR traded about 15.6% above the equivalent Korean share. After the Seoul stock plunged on Monday, the gap widened beyond 25% during trading. U.S. investors were paying more for the same underlying earnings. Part of that premium buys convenience. SKHY trades in dollars during American market hours and inside a regular U.S. brokerage account. Some funds cannot trade in Seoul. Others prefer Nasdaq liquidity and U.S. custody. Scarcity adds to the premium. The ADR represents a small slice of the company, and investors cannot create unlimited new receipts whenever demand spikes. A textbook convergence trade would sell or short the expensive ADR and buy the cheaper Korean share. The trade profits if the two prices move closer. Execution creates the problem. Investors face different trading hours, currency risk, settlement rules, and restrictions on converting Korean shares into ADRs. Those frictions can keep two prices apart for longer than most retail investors expect. Buying the expensive ADR while shorting the cheaper Korean stock is a different bet. It only works if the American premium persists or grows. Calling that free money ignores the risk that the gap closes. The Korean sell-off had more ordinary drivers. Investors had spent months buying the Seoul shares ahead of the Nasdaq event. Once the ADR started trading, that catalyst was complete. Funds took profits, while some international investors shifted their exposure toward the new U.S. security. The offering also created new shares. That added supply at the same moment early holders had a reason to cash out. Price gaps and profit-taking can produce a rough session. Leverage turned this one into a crash. How selling fed on itself. Korean investors had poured borrowed money into semiconductor stocks, margin accounts, and leveraged single-stock funds during the rally. Leverage feels wonderful on the way up. A falling stock changes the arrangement fast. Once an investor's collateral drops below the broker's requirement, the broker asks for more cash. If the investor cannot provide it, the broker sells the position at the market price. The broker does not care about HBM4 or your 5-year AI forecast. Mirai Asset Securities reported that forced liquidations in the Korean market jumped from 29 billion won to 142 billion won in a short period, close to a 5-fold increase. Margin calls also arrived before the forced sale. Monday's decline may have included only part of the accounts under pressure. Selling pushed the price lower. Lower prices created new collateral shortfalls. Brokers then sold more shares. The pressure spread beyond Seoul. SK Hynix's ADRs dropped in Monday's U.S. session, and American memory names such as Micron, SanDisk, and Western Digital also fell. The Nasdaq wrapper did not protect investors once traders began cutting exposure to the entire memory group. This price action tells us that positioning amplified the decline. Investors still need to examine the business risk that made traders so willing to sell. Can these profits last? Investors already know SK Hynix will earn a great deal of money this year. They want to know what its margins will look like in 2027 and 2028. Samsung, SK Hynix, and Micron are spending heavily on new capacity. SK Hynix is expanding production in Korea and building advanced packaging capacity in Indiana. Micron has increased its U.S. investment plan, and Samsung continues working to close the HBM technology gap. Those factories will add supply. AI demand may absorb it. Trouble begins if Microsoft, Amazon, Alphabet, or Meta slow their infrastructure spending around the time the new capacity starts producing chips. Memory manufacturers have lived through this cycle before. Tight supply pushes prices and margins higher. Producers respond by building factories. The factories take years to finish, and they sometimes arrive after demand has cooled. Morningstar expects capacity coming online in 2027 and 2028 to ease supply conditions and put pressure on prices. Investors also want proof that SK Hynix can ramp HBM4 at scale rather than meeting a launch date with limited volume. Competition raises the stakes. SK Hynix leads HBM today, but customers want more than one supplier. Improvements at Samsung or Micron give Nvidia and other buyers greater negotiating power. The stock price makes each of these questions more urgent. SK Hynix gained more than 7-fold over the past year. It no longer trades like an overlooked Korean memory producer. Investors have priced in HBM leadership, continued AI spending, and high memory prices. Strong execution may no longer lift the stock if earnings stop beating increasingly ambitious forecasts. A great company can become a difficult investment when its valuation leaves no room for an ordinary quarter. The market is now balancing tight supply over the next several quarters against the risk of excess capacity a few years from now. The return depends on how much cash SK Hynix can generate before that balance changes. AI memory demand hasn't disappeared. Current industry evidence still points to tight memory supply. SK Hynix has said its 2026 output is committed, with supply pressure extending into 2027. CEO Kwak No-jung expects customer demand to remain above the company's production capacity beyond 2030. Management has an incentive to sound confident, so outside forecasts matter. UBS expects the global DRAM industry to remain undersupplied until at least the second quarter of 2028. Nvidia CEO Jensen Huang has also warned that AI memory shortages could last for years. Bank of America estimates that global hyperscaler capital spending could reach about $851 billion this year and $1.15 trillion next year. Spending near that level would support demand for HBM, conventional DRAM, and data center storage. Agentic AI could widen the opportunity. An AI agent does more than answer one prompt. It keeps longer context, performs repeated inference, and moves large amounts of information between processors, memory, and storage. HBM feeds the accelerator. Standard DRAM holds active data. NAND stores the information that these systems need to retrieve. Better algorithms may reduce the memory needed for one task, but lower costs can encourage more AI use. Companies deploy applications that were too expensive before, and consumers run them more often. Economists call that the Jevons paradox. Cloud computing and internet bandwidth followed a similar pattern. The cost of each unit fell while total consumption climbed. Investors should treat that as a plausible demand path, not a guarantee. AI companies still need to turn spending into revenue, and efficiency gains may not create enough new usage to absorb unlimited chip supply. The bullish thesis only requires the shortage to last long enough for SK Hynix to convert its HBM lead into cash before new factories reshape pricing. 5 signals to watch. The next earnings release will give investors the first hard test. Compare actual second quarter operating profit with the 60.4 trillion won forecast that helped trigger the sell-off. A result closer to the previous 65 trillion won consensus would suggest traders reacted too aggressively. A weaker result would show that expectations still need to come down. HBM4 provides the second test. Listen for production yields, shipment volume, and revenue contribution. A company can announce production while shipping too few units to change earnings. Customers buying HBM4 at scale would carry more weight. The ADR premium deserves the same attention. An American investor paying 20% or 25% above the Korean equivalent is paying for access and convenience. Nasdaq does not give that receipt a larger claim on SK Hynix's profit. Limited supply and conversion restrictions may preserve part of the premium. It can also shrink through a falling ADR price, even if the Korean stock goes nowhere. Hyperscaler capital spending provides the clearest demand check. Microsoft, Amazon, Alphabet, and Meta do not need to cancel the AI boom to hurt memory shares. A broad move towards slower expansion or cost control could cut future earnings estimates. Korean leverage is the final short-term signal. Valuation models offer little help while brokers are liquidating accounts. Stabilizing margin balances and lower forced selling volume would show that price discovery has started working again. Investors who want long-term exposure can spread purchases across several entries instead of making one large decision during a liquidity shock. US buyers should separate their view on SK Hynix from their view on the ADR premium. Those are two different bets. The business and the stock moved apart. Friday's Nasdaq rally did not prove that SK Hynix was cheap. Monday's Seoul crash did not prove that AI memory demand had collapsed. Investors had priced the stock for near-perfect earnings, borrowed heavily to own it, and spent months anticipating the American listing. A lower profit forecast arrived as the listing catalyst expired, and forced selling magnified the reaction. The HBM business remains strong. The stock now faces a harder test. SK Hynix must show that HBM4 can support another earnings leg before new capacity threatens memory pricing. American investors also need to decide how much they are willing to pay for the convenience of SKHY. The next earnings report should tell us whether Monday created a better entry price or exposed expectations that still have further to fall. Do you see SK Hynix as an AI memory leader on sale or a great company approaching peak cycle profits? Tell me in the comments. Subscribe to TradingKey for more market analysis, and I'll see you in the next video.